Welcome to Beyond Beta with Kaia. This is a podcast where we discuss alternative markets and we speak with the managers shaping these markets. Today, we are diving deep into the world of traditional private credit. And my guest today is Toreigh Stuart. Toreigh is a managing director at Garrington Private Credit. Garrington has 25 years of history, and their private credit strategy, I think, arguably has generated some of the most stable returns in the industry, between 8 to 12% annualized without a negative month over the last 10-year period. Welcome, Toreigh.
Thank you. Thank you for having me.
Toreigh, you are an industry veteran. I know that you've been in the business for more than 25 years, and I think you have seen it all. So tell us a little bit about yourself.
Absolutely. Well, I started in the business as a stockbroker right out of school. I was given a phone book and told to call people and get new accounts. I was quite good at it, abnormally good, and had a tremendous success in my first couple of years in the business. But I didn't know a lot about managing money, so I bought mutual funds for my clients. And I bought the Fidelities, the Franklin Templetons, all the big names. You used to make tremendous commissions back in the early 90s doing that. So I was making more money than I had ever dreamed about. Had a lot of success, and it all was going swimmingly until I hit my first bear market in 94. And 94 just absolutely crushed me. I remember sitting in my office a nice summer day, staring at the ceiling, going, what have I done to these poor people? And it was awful. Anyway, I really got imprinted on me not to lose money for people from that point on. And so I've always been on a quest to do that. I immediately, after that bear market, became a portfolio manager and started to buy stocks and portfolios myself. And built a good business with one of the Canadian banks, helped them build their discretionary program. Everything was going great until 99. And in 99, I had the reverse problem. Everybody around me was making so much money, and I wasn't making hardly any money for my clients. I had bank stocks, utility stocks, etc. Anyway, it was a great first 7 or 8 years of my career. And in 2000, I got hired to run a fund company in Canada. And the very first thing I did was turn it into a hedge fund only alternative asset management company, and spent the next 15 years raising capital and managing hedge funds for various Canadian and global hedge fund managers. Launched about 20 strategies during that period, and really liked hedge funds. They're very sophisticated, as you know, very sophisticated vehicles. You've got more tools, more things you can do. And so I really enjoyed that part of my career, but found that no matter how good a manager, how good a strategy, there would be periods when those hedge funds would underperform. That's the business we're in, right? So fast forward to end of 14, I worked for a big global manager, Man Group. I ran their Canadian office, and myself and my partners, we got the opportunity to buy the business in Canada and diversify into other asset managers. And in 14, as we were looking to develop new products, I came across Garrington Capital and private credit, and I was just enamored about the risk-adjusted returns offered in this space.
Now, that's fascinating. And I really like your comment about the pain of losing other people's money, because as a professional money manager, I've been through that. You've been through that. This is something that really imprints on your DNA. And if it doesn't, there's something wrong with you. And I fully appreciate those comments.
It's awful. And it's, the reality is in the money management business, it's easy to do. You can be so right for so long until you are wrong. And it's in picking stocks and managing most investment strategies, it's really out of your control. It is as smart as you can be, as prepared as you can be. It's a subjective thing, picking securities and managing certain strategies. It's almost predetermined that you will have rough spots in your performance history. What I like about private credit, if you manage private credit a certain way, if you do it the right way, you will make mistakes. You will have bumps in your track record, but you can build a portfolio that leads to a much smoother return profile over time. You can predetermine that by the way that you're investing, which we'll talk about today.
Yeah.
But it's an amazing strategy and area to be if you can do it the right way.
Yeah, you were alluding earlier to risk-adjusted returns, and we'll come back to that point a bit later. But, we can't have a investing podcast in 2025 without talking a little bit about macro. In particular, Garrington is based in Canada. I know you are dialing in from beautiful Bahamas, makes me very envious. But Garrington is headquartered in Canada, and you do predominantly business in North America. So obviously, this region has become the topic among most macro analysts recently around the geopolitics, right? So tell me, how do you see the current situation playing out? I'm referring to the tariffs, I'm talking about trade war. And how do you see this impacting Garrington's business? And how do you factor in this political risk, if you will?
Yeah, there's so much to answer that question. And we've obviously had so many calls with investors and prospects about this issue over the last couple of months. Look, from a purely macro perspective, I personally have been quite concerned about North America for years. The US, as we know, is a superpower, but it seems to have been on the decline. And my sense of what's been going on politically over the last couple of months is that the acceleration of that decline as a world superpower will pick up, and we worry about that. We've been very worried for the last couple of years about real estate prices in both Canada and the US. We've been very worried about personal balance sheets of consumers. There is a lot of debt in both Canada and the US, and the increased interest rates, it's caused damage to both the US and Canadian economy in both of those areas, real estate and consumer balance sheets. We think some of that damage has been hidden, and I personally believe that the events politically out of the US in the last couple of months will accelerate that damage. So we're concerned about it. Now, that being said, I'm going to give you a very flippant answer, which is we really ignore the noise. It's what I love about this strategy. We are meat and potatoes. We block and tackle very simply loans to businesses against their assets. Now, what's happening in the macro perspective of the world always has an effect on what we do. But we very much pick our investments on a company by company basis. We look for businesses or other lenders that have tangible assets. We assess the liquidation value of those assets. We set an advance rate, very much like a mortgage, and we lend money to that borrower. When we lend that money, we take a first lien on those tangible assets, and then we take a lien and put covenants above. So the way that our average advance rate's typically around 50 to 60% against the liquidation value of those assets. So it's complex, but yet quite simplistic what we do. And so what's happening globally and the tariffs between the US and Canada and the US and other countries, it will have an effect on a company by company basis. It will mean we'll choose other companies and avoid some industries. Quite frankly, I'm excited. I think what it'll mean is there will be certain industries where investors are running from because of tariffs that we can actually step in and get a better risk-adjusted return because we'll get more assets, we'll get a higher yield, even if those companies are affected by tariffs. Or it will mean we have to exclude certain companies that are affected by tariffs. But look, nothing really changes in our day-to-day. We don't get too excited about the noise. We pay attention. It changes how we build our portfolio. But yeah, it's business as normal for us today.
I guess that, such volatility in the marketplace, and volatility can be measured in many ways, right? I guess it does create opportunities. And I think in general, private credit has been the winner in recent years from different macro events, be it regulatory change, be it just capital flows into certain regions around the globe. And I think on an aggregate basis, the industry has exploded. It's almost doubled within the last 7 years, right? So we're coming to like 2 trillion in market value. And there's a saying, some people say it's by Mark Twain. Some people say it's by Maslow. It's that with a man with a hammer, everything looks like a nail. And offer private credit gets this bad reputation that when you need money to deploy, you will basically deploy it everywhere. Now, how do you at Garrington manage that underwriting risk, making sure that you don't compromise on your criteria and that you follow the same stringent requirements that you just listed out earlier?
Yeah, I mean, there's so many ways. I mean, I have a saying, trees don't grow to the sky. I hate that all this money is pouring into private credit.
Yeah.
For whatever it's worth, we saw the opportunity 10 years ago and kind of jumped on it. But we don't see a lot of the flows that are coming into the business. It's coming into big name managers, the Apollos, the BlackRocks, the Ares, the Barings, right? We never compete. We focus on a sub $20 million loan market for the most part. It's a very fragmented market. There's not as many flows coming in. And I very much believe fundamentally that the lending business has been around since the beginning of time, and it will be around for decades to come, and there will always be opportunities. One of the things that we do is we spend a tremendous amount of time and effort and bandwidth on origination. And we try to look at more than 100 loans a month and pick a couple. And we're increasing that. And so one way to win in this is business. I could go on. You could give me 20 minutes and I'd still be talking about this question. So I'll try to shorten it. But I've lost at Garrington a number of salespeople who have said to me, you can't get a loan done at Garrington. And I have a number of referral sources that believe the same thing. We are very robust and stringent in what we do. Okay. We look for tangible assets. We need to understand the liquidation value. We need to know those values are changing, and we need to put a perfected lien on those assets and feel comfortable with that. We never deviate from that. But where we get a competitive advantage is we're completely flexible to industry, loan vertical, geography between the US, Canada, state, province. We are so flexible. And by being flexible, we can look at a lot of different types of opportunities and find the ones that meet our criteria. Okay, that's very, very important to us. I think we win by finding loan opportunities where we're not competing with others. I do not like to compete with 6 or 7 other bidders. I like to be good at origination and marketing. So we find those borrowers where we can get the right terms in that loan. Now, we're very fair lenders, but there's a certain amount of collateral and a certain interest rate we need to get. You get that by having the luxury of choice, by seeing a lot of opportunities. And last but not, sorry, there's 2 other things. We are completely transparent in what we do. So we show our investors our portfolio on a monthly, quarterly basis, and we ask them to challenge us. Are you seeing changes in our criteria? You have a look through. We're going to go through it with you every month, every quarter, and you tell us if you see something that's changing, right? So we have a check and balance in place, okay? We also have independent auditors and field auditors that come in and look at the portfolio. And then lastly, I showed you when we first met, Kaia, a chart that shows our rolling 12-month returns. And our history has been our rolling 12-month returns have averaged between 7 and 12% a year over the last 10 years. Okay. Our objective is to get between 9 and 11% per annum net of fees for our investors over the long term. Okay. Now, you pointed out we never had a down month. I hate that. By math, we really should have a down month. I expect one every 15, 18 months. It will happen. We have losses. We lose on approximately 80 basis points per year historically. We have before and we will in the future. We're always having to work on something in this loan game. Now, we put the odds in our favor because we have a loan to value against a tangible asset that we can liquidate. So we shouldn't have a lot of losses, but we have them. Now, I spend a lot of time working with salespeople that say what you just said. We've never had a down month. Look how perfect we are. And I point out to our potential prospects, no, we will have the odd down month. Okay. I spend a lot of time showing our investors that chart that we expect to get between 8 and 12 or 9 and 11. And historically, we've never had worse than 7%. I actually expect that we will have a year when we only make 2 or 3%, when everything goes wrong over the next 10 years. Today, our portfolio is stronger than it's ever been, but that doesn't mean things won't come up that surprise us. Okay. Now, I also spend, I'm going to finish off quickly. I also spend a lot of time telling people it's not always going to be this good, but we firmly believe we will never have a negative 12-month period. We're getting yields of 13 to 14%. And we should never have losses greater than 13 to 14% in a year. So everything that we do as a firm is driven off that track record and sitting down with you in 10 or 15 years and all our investors and showing you that we continue to deliver on that track record. So because of that, we limit how much money that we will bring in, and we tell our investors that from time to time we will give them back capital because we can't find the opportunities. And that's our promise to investors, that if we do not see the opportunities that fit our criteria, capital will be given back temporarily until we do find those opportunities.
You've given so much interesting data points, and I actually struggle now what to address first. I'll address first your average loss, which you said is 80 basis points every year, right? This is below private credit average, which is about 2%. So this is actually very remarkable achievement because you are below average. But I do want to ask a little bit about your deal flow, because you mentioned that you review 100 deals per month and you approve 2 or 3. How do you manage that deal flow? Like, what is the use of technology? How big is your team? I'm just trying to understand how the funnel works for you.
No, it's interesting. Look, I think we're very technology oriented in certain aspects of our business. We have divisions in fintech. We have invested with fintech companies historically, but I'm very subjective. I think that what we do is quite qualitative. I think that it needs a human body on it, and I think it's really about training our sales reps and our referral sources of what we need and what we want. So a loan comes in to our origination team. A lot of those 100 loans get kicked off very, very quickly. Maybe 40% will come through and we'll look at them with more seriousness. And it's really just being disciplined and knowing how to get a no out to investors quickly. We know what we want. We're looking for tangible assets, property, plant, equipment, inventory, receivables, good quality loan portfolios. It can be done very, very quickly to know if there might be something there. Now, to then lend to that company, a lot of other due diligence has to be done, but I think it's more subjective, qualitative, and done by a human being versus.
Yeah. So this is truly the, as I alluded earlier, traditional private credit, like how private credit was designed to be, if you will, right? Looking at the balance sheet, looking at the assets, you have origination team, you do structuring, you take collateral. And when something goes wrong, obviously you have the assets to fall back on. But I want to ask a little bit about, let's say if an investor wants to allocate to private credit, and given your experience, given the market dynamics, what are the, let's say, 2 or 3 questions an investor should ask from a private credit manager before making a decision if they want to allocate?
Yeah, it's so tough. I've had investors that have friends, partners, other people that have invested in other private credit managers that I've felt in my gut or maybe even knowing that there's problems with. It's very hard to talk about competitors that way. And I've said, have them show you the portfolio. And my prospects or my friends have said, well, I don't know what to do with that information. Okay. It's very, very tough. I think transparency and really understanding what that private credit manager does is very important. So look under the hood the best you can. Get somebody who has some knowledge to do the diligence, to look under the hood, and then continue to monitor that manager. And that's the best you can do. I mean, it's a bit subjective gut feel. You've got to see what's under the hood, and you've got to be able to monitor on a regular basis.
And how do you tackle the monitoring topic? Because often the monitoring is done looking in the rear view mirror, right? Like you see some sort of financials that could be, 12 months old if they're audited, perhaps, last quarter?
Yeah.
How do you tackle that?
Well, for us, monitoring our borrowers, monitoring them weekly, bi-weekly, at a minimum monthly. Okay.
Okay.
So yes, maybe you're looking at financials that are a month old. It really, it depends on the type of loan. So we're looking at term loans against hard assets like equipment or real estate. We're looking at them once a month. We're looking at the financials, but and we're sending in field auditors or appraisers to look at the values once or twice a year. Okay. So that's all you need to do off a hard fixed asset. It's enough. Okay. But most of our facilities are revolving facilities. We're actually looking at the borrowing base once a week. Those companies are drawing capital from us and paying us back on a weekly or bi-weekly basis. So we're on top of it. We have a portfolio management team. It's a very important part of what we do, that's looking at that collateral base very, very frequently, so that we know exactly what we have in the form of collateral. And it's an
Yeah.
important part. Again, when I talked to you earlier on, I told you previously, there's 4 cogs to our business that are important. Origination, it starts with origination, and then really robust underwriting and entrepreneurial. And the third area is account management. You have to be on top of your borrowers. You have to understand the problems that can occur early or are occurring early. So as I told you, our average LTV is about 60%. We're in relatively good position, but you have to find the problems right away and force that borrower to put money in or sell assets as soon as they get offside. You've got to be on them, right? And so monitoring is very important. So you're not looking in a rearview mirror. Now, we were talking a little bit about how other people assess private credit funds and do the monitoring. You just have to up the frequency of that monitoring to a degree and be really on top of it.
Yeah. My experience managing private credit often has been around cash management. And you mentioned that you offer also revolving credit lines. And these are notoriously tricky to manage because it's very hard to predict what the actual drawdown from that line will be. So I guess it makes sense that you do occasionally distributions or redemptions. And I'm glad to hear that you have found a set of investors who are agreeable with this, because often private credit investors, they are expecting their maybe quarterly dividend, maybe their semi-annual dividend. But it seems that you really have established, let's call it a set of rules. You are very, determined to follow those rules. There's little navigation around them, and it's almost investor, either they take it or they leave it.
Very much so. Yeah, very much so. And as we build out our fund, our goal is to just have, just like the loan side, more capital and investors that want to come into what we do than we have availability, and just to be able to pick and choose investors that meet our mindset. And part of that is investors that don't want to make too much money. Like we're not, we are what we are. You can't turn an apple into an orange, right? We are there to deliver that 9 to 11% over time. And we can't do more than that. And I often get complaints that we don't deliver enough return for people. That is a frequent complaint. And we're not for you. It's just not what we do. We protect capital. That's the first thing that we do. Making money is a byproduct of that.
I like your motto, because your motto is also that you win by not losing, by protecting capital. But tell me, Toreigh, also, who is your typical investor? Maybe there is a profile that generally wants to invest in such a product.
Investors that want to make 9 to 11% per annum and don't want to have a period where they lose money over a
Are they
12-month
multi-asset
period.
managers?
I
Are they
really,
family offices?
I am gonna. It's a flippant answer, but
Yeah.
I will give you a better answer. But it really is people that want to do what I just said. We have pension funds that have invested with us.
Yeah.
We have big fund companies that have invested with us. Wealth managers, banks on behalf of their clients. It's an array. family offices. It's an array right across.
So I know that you have also gone through the pain of doing CFA, as have I. So sorry to hear that. And CFA has this notorious chapter about asset liability matching. So that asset liability matching is relevant in your case two ways, right? Firstly, you have to manage your own asset liabilities. And also, you are the perfect portfolio company for other companies that need to have asset liability mismatch. And you alluded already to pensions. I'm assuming insurance companies, for them, it's such a natural fit to have the stable yield. Maybe occasionally it's a bit unpredictable if you choose to do that early redemption or distribution. But like you said, on a risk adjusted basis, this has to be one of the best returns that you can get in 2025.
Yeah, I think in 2025 and over time. I mean, you asked me about my career. It's been 33 years leading to what we do today. I believe
I
what
said
we do.
25 only. So sorry, I took a few years of your
That's
experience.
okay. I'll take it as
You
a
look so young,
compliment.
that's why.
Yeah, yeah, sure. I don't feel so young some days. The private credit isn't great for keeping young. I think that it's a strategy that's for all
Mm,
periods. I really
mm,
do. There's lots of great things that you can invest in this world. I truly believe the way that we manage our portfolio, and I won't speak
mm,
for other strategies because I don't spend a lot of time looking at competitors and seeing what other people do. It's not important to me. What's
mm.
important is we do what we say we're going to do, and we
Yeah.
do it day in, day out, year in, year out. So sure. I think this year, when there's a lot of volatility, we stand out as providing better
Mm,
risk adjusted return. But we are trying to set something up for a long period of time
mm.
to provide better risk adjusted returns because we're taking advantage of an inefficiency in the market. We're able
Yeah.
to get yields of 13 to 14% with tangible assets covering us,
Mm,
have controls inside a business, actually have the bank accounts for a lot of our borrowers under our control. It's an inefficiency that just it's not because we're so good, where I do believe we're good at what we do, but we're taking advantage of an anomaly in the investment market that
mm.
gets you more return per unit of risk, period.
How do you see the regulatory changes coming out of the US? And I'm referring to loosening the bank lending requirements, which haven't happened yet, but they sort of are on the agenda. How do you see that impacting your business, given
Yeah.
that you do quite a bit of
Yeah,
business in the US?
it's interesting. The business ebbs and flows. So,
Mm,
5 years ago, there was a lot more competition from banks. I know we've been in a period where the regulation has tightened for a lot of years, capital constraints have tightened, but 5 years ago, we still had a lot of competition coming from banks. When we went through the Silicon Valley bank crisis in the US 2 to 3 years ago, it created a big pullback out of our market because of lack of deposits for mid-market banks in the US. And so
mm,
we have a lot more opportunities today than we had before. I think it's always going to ebb and flow. We
mm,
could have more competition, but it's just noise to us. There's always opportunities. There's always little things we can find. There's always people that need money because we move more quickly than
mm,
most banks, and
mm.
we are more entrepreneurial, and we can look at things that are a little more esoteric, or we will lend to companies that are losing money if they have assets when most banks don't, right? So there's
Yeah.
always a competitive advantage, small versus large, David versus Goliath. There's always opportunity. So it might slow us down for periods of
Mm,
time, but I truly believe, we don't have big ambitions. We run $230 million right now. We're going to probably cap at $1 billion. I believe there's always going to be about $1 billion of opportunities in front of us that we can take advantage of no matter what's happening.
I like the fact that you are highlighting noise, because one of the slogans of the podcast is cutting through the noise in
So,
institutional investing. So spot on. Where do you see expansion for Garrington happening? Because I know that you have, if I'm not mistaken, ambition also go to LATAM to some extent. I think I picked up
yeah,
from one of
you
the
did.
webinars. So tell me, where do you see the market expanding for you?
Look, from a capital raising perspective, we're all over the world right now, as you
Yeah.
know. Yeah, from a lending perspective, we're looking at markets that follow British law. So the
Hmm.
UK, Cayman might be an area where we occasionally see the odd opportunity. Those are markets that fit. We like the LATAM market from the perspective that there's a lot of borrowers that are selling into the United States where we can buy receivables that are actually issued by U.S. companies, and we can get credit and insurance on those receivables, et cetera. So we're noodling at those types of opportunities where we can get outsized risk-adjusted returns. But I've got to tell you, we have a lot on our plate right now. There's a lot of opportunities in North America as it is, and my credit team doesn't move to change into new markets that could be risky too quickly. So wherever we go, we have a lot of work to do from a legal perspective to make sure we understand the laws.
Yeah, that's fascinating. We are coming to the end of the podcast, Toreigh, and I have always three questions I ask from every guest. These are a bit more personal in nature. For context, Toreigh doesn't know these questions.
Couldn't you have given me a heads up
Absolutely not.
before?
Absolutely
Come
not.
on.
I'm testing how good are you at shooting from the hip, but these are, you're gonna tap into your experience. Toreigh, what has been your biggest professional mistake, and how has that experience shaped you and how you conduct business?
Oh my God, so many.
You can choose the least embarrassing one.
Yeah, no. I've had a pretty good career in providing returns to people. In the hedge fund business, we gave money to a couple of managers that really disappointed. Probably the ones that bother me the most is I've been in private credit for 10 years, and early on, we allocated capital to Garrington and other private credit managers 7, 8 years ago. And a couple of those private credit managers deeply let us down. So I'm embarrassed about that, and I do an awful lot for those investors to help get them out of those. But I think that I've learned in the private credit space, there's a massive difference in quality of managers, and it is very easy to get it wrong. Maybe a little bit to your question earlier on, that it's we rarely will co-invest with another private debt manager because we do it a certain way, and it's so easy to lose money. So that's probably been my biggest mistake.
Okay. Who has been your toughest boss or mentor? You don't have to say the name. And what is the lesson from them that you still carry with you?
I haven't had a lot of bosses in my career. I've been almost my own boss.
You've been your own toughest boss, probably.
Yeah, that's true. But I did have a gentleman who's crafted my career, who was my boss, and he taught me to be very fair in how you deal with your partners, but to always get into agreements up front, fail safe things in case your partners turn on you. So it was a gentleman that he was incredibly fair in how he dealt with his business partners, but he was so good and meticulous about getting things and agreements up front. And I'm very, very conscious in loan agreements, partnerships, employee agreements, to try to put the balance in our favor in case anybody turns on you, because you just never know what people will do down the road. So he was meticulous at that. And it was the combination of planning for having to put the hammer down, but being so fair to people when they treated you right. That combination was great for me.
You are the second guest who basically highlights the same lesson. And my first guest, Morgan, had exactly the same feedback or same takeaway from one of his mentors. So clearly, being prepared beforehand, documenting, being meticulous just in case something goes wrong is the way to go.
I might just add to that, when we make loans, I think we really think the character of the people we're lending to is high. That's very important when we make loans. But you just never know what people will do when the chips are down. It's people change. So
that one I've experienced myself, so I can vouch for that. And my last question to you, Toreigh, is what is a belief that you once held about markets or investing that you've completely changed your mind on now?
Built my career with a belief on public markets and investing in stocks for the long term, et cetera, and the value in that. I really have a belief today that there's a big part of public markets, which is about separating money and capital away from the common investor and putting in the pockets of the people who run those companies. I don't have a lot of belief in public markets. There are some great things in public markets, but I think there's an awful lot in the public markets and investing in general, where
Yeah.
people are Wall Street, Bay Street in Canada, are really trying to separate money out of people's pockets and put it in there. So I have a massive paranoia and disbelief in the investment industry.
Yeah, I again have to agree with you on this one. And you mentioned earlier that your career started with selling mutual funds and you earned tons of money from those commissions, right? And this is just
Yes. Yeah.
to show and prove the same point. And I think for young people, whoever wants to invest these days, only way to go if you want to operate in public markets has to be low cost ETFs tracking some sort of index. Make sure that your fees are low, that you don't pay to some sort of manager just for the sake of having their name or their brand
Yeah.
somewhere.
Yeah. Well, and if there's another lesson to impart there, everybody believes in recent history.
Mm.
In Canada, real estate went up for 30 years. It never
Mm.
went down until 3 years ago. And
Yeah,
people thought you could never lose money. And there are money managers out there who have 13 years of incredible returns until they lose a massive amount of money. And I think the common investor believes too much in what they recently have seen
yeah,
track record wise instead of actually looking underneath. I don't disagree with your philosophy on ETF investing.
yeah. And again, coming to the same point that you just made on the recency bias, I've seen risk models built out in 2018, 2019 by large institutional managers with a interest rate cap of 2.5%, which is a bit of a joke right now. But if you are quote unquote my age, you've entered financial markets post 2008 crisis, all you've seen are zero interest rates.
Yeah.
And the belief that the rates could go up to 4, 5, 6, 7% almost seems impossible. And there were models built based on that
Yeah,
assumption. So
many,
I
most of them.
yeah, so I think that guy got fired after that. Toreigh, thank you so much for your time. It's been great chatting with you. And thank you sharing everything about Garrington.
Thank you.